What did you think I would trade at this moment when we're looking at the options spreadsheet with tears of joy in our eyes? What are we looking at today here on the put scan? This is for puts, selling puts only on this options spreadsheet. What are we looking at? Again, we have this organized by annualized return, market cap above a billion. So all the companies listed on this spreadsheet have a market cap of $1 billion plus, annualized return of 20% plus. And I think I have implied volatility of 30% plus. So that is the list. That's how this was created. And then also I've got 30 days or less to expiration. That is on here as well. So a couple of things I'm looking at today. One is Google. Google is down. If we looked at the Googler, if we looked at Google, let's open that into a different link. They're down today. Samsung announced that they possibly are going to move their search engine on their smart TVs to the Bing-a-ding, ding-a-ling. Where is it? Did I miss it already? Nope, right here. Google stock falls on report Samsung could switch to Microsoft search engine. Could is the imperative word. I would imagine Samsung is saying, hey, maybe we'll say this and get a better deal from the Googler, because apparently Google makes, I want to say, billions of dollars a year from Samsung having them built into their smart TVs. Where are we at here? Open up. Any moment. There we go. Open that up. Okay, so here we go. Google stock fell Monday in the wake of a report that said its longtime ally, smartphone maker Samsung. What did I keep saying? TV? Yeah, I kept saying smart TV. They could switch to Microsoft's Bing as its default search engine amid the rise of artificial intelligence chatbot tools. Do you read much? No, I really don't. I used to read all the time, but I read so much, so many books for so many years on personal development and personal finance and real estate, etc., that I kind of burnt myself out. So in my semi-retirement, I listen to a lot of things. I do read about stocks and companies, but I don't read a whole lot of books anymore. I listen to them. It's lazy. It's fun also. So Google could lose about $3 billion in annual revenue if Samsung switches to Microsoft's Bing. So because of that, it is falling. It's going downtown to Chinatown today, which could be an opportunity for us to sell some put action on the Googler, because I don't think we have any puts currently on the table on Google. I know we have 3 contracts worth of calls. Again, we have an average cost of 92.47. That's pretty nice. 300 shares. And I believe their only positions we have options wise is with regard to those calls. So let's let it load up. Let that load up. Where are you at? In any second. There it is. There's our 2 strategies. We're really going slow in the farm fields of Valparaiso, Indiana today. So we've got a May 5th, $99 strike, 2 contracts, and then we have a May 19th, $100 call contract, both on the table, but no put action. No put action on the Googler. Let's look at it right here and right now as far as the chart is concerned. Let's go to the chart. Go to the chart and see what it's doing minute by minute. Minute by minute. And we are pretty flat, pretty flat here on the Googler. Oh, my computer's making that humming noise again. It's probably one of those 72 open tabs you have. There's just too much action going on there. All right, we're a little flat on the Google. could be an opportunity for us to make a move, though. 105.79, trying to go back up, trying to move its way up just a little bit. Let's see what the action is. Trade Google options, sell put. Let's go out 11 days to April 28th to see what we're working with. All righty then. So we'd be at 99 if we wanted to get that 1%er in there. But what does that do for us? Like, what does the spreadsheet say is the trade that they have highlighted here? It would be a 96 strike at April 28th, which would end in that annualized 2140. Okay, so that's nice and conservative, a 96 strike. So let's look out. Let's go another week out to, no, let's stick there. Let's stick it there just to see what that math is now on this. Is it changed on this 96 strike? So it was an annualized like 21% return on the spreadsheet, but that changes all the time. So if we go 56 cents and then we divide that by the $96 strike, that would be 5%. That doesn't seem right at all, does it? Divided by 11, multiplied by 365, 18. So it did drop under that 20. So the credit, and I don't have the bid and ask on this spreadsheet. I was going to put it on there, but I didn't. I'm silly. So currently that particular trade, 96 strike, 11 days out, instead of it being 21.4%, it dropped just below at 19.3%, but it is on Google, right? Google, fairly conservative trade on a very good company. Let's go out another week, though, just to see what kind of action we can get on May 5th. On May 5th, let's look down here. So that was a 96 strike. So if you stay at the 96, what does that do? Now, obviously, the time becomes a big factor as far as the equation is concerned, because we are adding 7 days to the equation. So we're at 85 divided by 96, divided by the number of days, 18, and then multiplied by 365. Now we've dropped to 17.9. And the reason is because there's the theta involved because of the shorter term trade, and then also the volatility becomes an issue because there's more time to manage this trade and less time if we went the week previous. But I'm good at that week before 105. I'm even thinking possibly the 97 instead. So what's the 97 math? 0.7 divided by 97 equals 007 divided by the 11 days multiplied by the 365, and now we're at 23.9% return on our capital. Now it's dropped down to 68. So Yahoo or Google must be going up and away. Clarice, I don't like the look of these bars. What's happening there? Let's take a different look. If we refresh this, do we get a better look at these candles? Let's find out. Barely. I don't know what the deal is there. Why they look crazy. Oh, there we go. Let's try to work with this. Zoom. No, that's still, I don't even know how to work this Yahoo Finance. Then why are you using it? I kind of know how to use it. I thought I did. Refresh it again. Maybe we'll get a better perspective. Maybe just a little better perspective on the Googler. Currently down 3.36% and going once, going twice. Yeah, that looks a little better to me, doesn't it to you? So we've got some green action, bigger green action as far as the candle size, the activities, the volume compared to the reds. So where are we at on that premium? It's at 69. Hopefully you didn't pick up on my stomach growling because it is that time of day. Let's look to start the wheel of fortune on the Googler. Let's look to start the wheel on the Google. Let's look for, can we catch 70 cents right in the middle there? $140 cash secured put, $97. It's only 11 days out. Let's review the order. $19,400 collateral and $140 collected. 2 contracts. There should be enough activity to fill that. There it is. So then the exact math would be 140 divided by the $19,400, right? Divided by the number of days multiplied by the annualized 365, 23.9. So there we go. That's our number, 23.9%. And yes, I did not do a credit spread because this could be or should be and is the beginning of the wheel for Google, because we've got some calls on the board that we may allow to be called away at a nice profit and then start spinning that wheel again on a down day on the Googler. So there we have it. There's our Google trade. I'll be back to check on that spreadsheet again. I think I'm going to eat, though. I need to eat very soon. I will do that, come back, get back to the spreadsheet. There's a few more underlying assets, a few more stocks going on today that I will likely be selling puts on. I will see you in the next video.